I think we're going to start. Okay, well, thank you for joining us. I think this is going to be more of an intimate affair here and perhaps really good conversation. Just to make sure that you're at the right place, this is the healthcare IT investment conversation. We have today, I would say, a very distinguished panel of investors and very international. So you'll get a lot of different flavors and viewpoints. How I wanted to, kind of get this process going. We'll do just a quick few minutes of opening remarks, but then go down the line and have each investor introduce themselves, especially their investment strategies and what they're looking for. Then we'll touch on some topics that thought it would be pertinent for this conversation, and then we'll put up for questions for the last 20 minutes, depending on how the conversations go. So again, welcome. You guys are, I assume, all interested in the healthcare IT now. It's interesting, if you talk to folks who are old-timers in the space, they understand what healthcare IT is now. I think it's been replaced slowly by the buzzword digital health. So when we use healthcare IT and digital health for now, we're going to use that in the same way. But although I think that one of the trends that we've seen is less about actual devices, but more towards the software and intelligence and data. So we'll probably have a more healthy conversation around there. One of the things that I think is important is we get an understanding, a level set of where things are right now, and Rock Health did a pretty good job of giving us some perspective about that. I could probably all have a chance to go over some of this information, but the good news is there are still a lot of investment being done in the digital health area. I think that there's clearly interest, not only a number of companies that are getting funded, number of deals that have gotten done, but number of new investors in the area. The more sobering thing is, though, we reached, I would say, investment going from literally nothing to $4.6 billion in 2015. In 2016, that actually dipped from 2015 peak of 4.6 down to 4.2 billion. And the other thing that we noted was that the size of the deal have gotten actually smaller, somewhat smaller, down from 15 million to 13.8 million on average. Another thing that we found was that the number of bridges have increased, the percent of bridges of a total number of deals. So you guys, we could all think through why that is the case, but one of the concerns is that people are not able to reach the milestones that they thought they could reach, and want some extra capital, extra time to get to those milestones before they go for another round of financing. Clearly, there's a lot of interest in genomics and sequencing, and followed by areas of analytics and big data. One area that has taken a little bit of a decline is in the area of wearables and biosensors. So just to give you a little more perspective and granularity into that. But I think overall, we're all here because we have interest in this space. I personally believe that this is an area that is at a very early stage of developing. It has a lot of legs to it. So with that being said, let me briefly describe my background. I'm actually CEO of an investment company called Digitex Partners. This is basically an investment vehicle that was funded by Astellas and NPM Capital. What we do is we look for early stage digital health companies. We're looking to deploy somewhere between $500,000 to a couple $1 million at the initial check, $2 to $4 million over the life of the investment. And we want to be an active investor. My background is I'm a physician by training, but also spent over a decade in venture capital, but also spent time on the operating side at a healthcare software company. And these are the things that hopefully we, the team at Digitex, will bring to the table to help develop companies to the next level. So that's me, but I'm going to ask Akil, and then down the line with Edward and Lana and which went at the very end. He does not. We do have a minute, so thank you.
Hello, I'm Akil Saklecha. I'm a partner at Artemin Ventures. We're based here in Silicon Valley. So what we do at Ardaman, we're early stage investors, typically seed and Series A for about 90% of our deals. Our fund sizes are typically about 200 million, and we manage just over 1 billion at this point. We also have 2 additional growth vehicles that are 150 million each that invest only into our company, so they're captive in that sense. What we look for are white space areas where there's not really any competition or any significant competition, and where the addressable markets are extremely large. So I should mention that we're sector agnostic, so healthcare is only part of what we do. It represents maybe 20 to 25% of what we do, and we've done a lot in different areas such as diagnostics, healthcare IT services. We've not really done as much on the biopharma side. Now, when I talk about the size of the market, what we look at is bottoms up typically about $10 billion of revenue potential to the company in the markets that they operate in. So that being said, I'm a physician, an emergency physician. I still work in an ER about 3 days a month. I've been doing venture for about just over 8 years now. And I typically, the way I look at healthcare IT is, myself as a user, how would I utilize the product or the platform that's being pitched, and do I think it'll work? Do I think it'll be easily adopted? Is even in the beginning, the user experience may be okay, but can it be improved on? And is it really solving a must-have problem, right? Because I think that's really key. So that's the way I look at healthcare IT, and I'm going to turn it over to Edward here.
I'll try and do it without a microphone, so if you can't hear me, or can we get it here?
Yeah.
Perfect, we can.
So, my name is Edward Kliphuis. I'm an investment director with Merck Ventures. Probably I'm in a legal breach actually using the word Merck here, because it should probably be called EMD. That's the big conflict between the German Merck and the US Merck. I'm part of the German Merck. We are a 300 million fund, evergreen. It's basically dedicated to 4 different things. So we started in 2009 purely investing in therapeutics. After that, we essentially now late last year reorganized the fund and added a few extra strategies to it. So one of which is digital health. Essentially our philosophy for digital health is purely centered around patient outcomes. So whenever we look at something, it is always important for us to make sure that we have an impact on patient outcomes. Be it in adherence, be it in comorbidities, be it in solutions that can be deployed alongside disease-modifying agents. So with that, we're fairly broad in the sense of what we look at, but that is the key. There has to be some sort of data proving that the investment or the technology does make an impact. We like to go early. We do seed from a couple of 100,000 up to, let's say, Series B investments in the million range. We can go up to 10 to 12 million over the life cycle of a company. On a personal level, I'm a fairly unsuccessful scientist, I might say. My background is in pharmacology, but I ventured out into the finance side pretty soon after that. Investment banking, after which I joined the healthcare investment team, so first therapeutics, and now setting up the digital health side for Merck Ventures.
Hi everyone, my name is Lana. I'm on the verge of losing my voice, so bear with me. So David, once you decide to ask me a question that I don't want to answer, I'm going to tell you that I've officially lost it. I was born and raised in Jordan. I did my undergrad in finance and marketing in Canada, then did 3 years of investment banking in London, and I did my MBA in Boston, and then in 2012 I joined Hikma Pharmaceuticals in a strategy role. So I got to basically work with different teams across different geographies and on different mandates ranging from BD to M&A. And just to give you a brief background about Hikma, Hikma is basically listed on the London Stock Exchange with a market cap of around $6 billion. Our revenues are close to $2 billion. We sell our products in more than 50 countries worldwide. We have 29 manufacturing facilities spanning 3 different regions, including North America, Europe, and the Middle East and North Africa. And basically, just in 2015, very recently, we decided to put together a corporate VC fund, which we called Hikma Ventures. And because it's from the balance sheet, we're not really going to specify a specific amount. Initially, it was 30 million, but now we're seeing a lot of traction in this field, and we're probably going to be spending more than that. In terms of the stage of investment, we could invest in seed to Series C. So far, we invested in 2 companies, one in Series B and one in Series C, both US-based. We're globally agnostic. We're a global fund, so we're geographically agnostic, and we could invest as low as $250,000 and as high as $3 million per company per round. So that's us in a nutshell.
Hi, my name is Sven Lingjerde from Endeavor Vision. We are a Swiss-based venture capital growth stage fund. Our last fund that we raised in 2016 is a 250 million euro fund, investing mainly in growth stage medtech and also in emerging digital health companies. We invest on both sides of the Atlantic. Most of our investments to date are in the US. We are a team of 9 people, including some veterans from the medtech industry. And basically what we look in terms of investments, we first look at the repeat entrepreneur. And I'm speaking now specifically about digital health, because on the medtech we are post-regulatory and the strategy is slightly different. But on the medtech we are looking at people who've seen the film before, coming from the industry. We are looking at more medical grade companies, B2B or B2B2C. We are looking at companies that can lead in their sector or can displace an incumbent. We also, because we are a late stage investor, we want to see the hyper growth curve. So we are not really centric around the turnover of the company, but it's more about the market penetration and the ability of the company to really make it. And I often use the term that we want to see if the dog eat the dog food before investing. And so we are looking for momentum companies. So I guess that's it.
Good, thank you. So I'm hoping that we'll have a brief flow conversation, but just to start it off, I describe a few statistics to start off. But in your personal experience, how do you think 2016 went for you? Do you think that the momentum is going up, going down, stable? So I'll just leave that out to you, and then there will be other questions that we will follow up on.
I think from our perspective, we've seen it to be fairly flat. We've actually been very cautious on investments. I think there was maybe a number of reasons. I think we ourselves have been focused on making sure that we are kind of batting down the hatches and addressing our portfolio companies' needs and looking for really special opportunistic investments. And part of that is, I think if I look back and try to understand why, it's we're seeing a lot of very good opportunities. We're trying to look for the best opportunities, and there's companies there that are getting. I think if I look back 5 years ago, we would do a lot of proof of concept investments, and now we're starting to wait a little bit for companies to be a little bit farther along. And it deals with things that we're dealing with internally, which is we're starting to see a funding decrease on the Series B and a little bit on the Series C. And I think David alluded to this earlier, which is investors are downstream are waiting for more, I think companies to be farther along and making sure they're hitting their milestones. And so a lot of times early stage investors have to be really careful on companies executing and making sure they're performing. And so we've been very focused on making sure our companies are addressing that first. And so just by default, the companies we're looking for have to be a little bit farther along than what we've done traditionally. So that's kind of what the way we've looked at things and how maybe the last year had gone for us.
I mean, it's hard to compare for us, David, because we essentially established this out of the fund only last year. So we did our first investment, so by that measure, it was an awesome year. Other than that, what for us been a very interesting observation, and this is pretty much along the line what Akhil said already, coming from the traditional therapeutic side, the realization within the team that needed to be installed that actually digital health is really and truly a hybrid space where you have the ability to pivot much more than you have, for example, in drug development. In drug development, after you select your lead candidate, that's it, it's project management. And sorry if I offend people by that. But there's nothing really you can do to tweak the molecule anymore. Whereas here, all of a sudden you can change the premise of the company, the focus of the company, you can pivot and twist. So with that, the team becomes much more of a focal point. And so that has been, for our team, certainly a learning curve and something to actually keep in mind for future investments.
So, just like Ed, it's hard for us to compare, given that, last year was our first year. But in terms of trends that we've seen, to your point, David, initially, we've seen the prevalence of bridge rounds, given that it's been, investors have been very picky. And basically, a lot of early stage startups, especially who are trying to jump from seed to Series A or Series A to Series B, have to prove more tangible milestones in order to get the funding. And in terms of focus, generally we've seen how currently consumers or individuals want to take matters into their own control. There's kind of an upward trend when it comes to personalized medicine, when it comes to wearables. There's basically, in my opinion, there has to be some sort of like reinvention, because they are on the decline. And in order for them to kind of pick up again, they have to kind of use personalized coaching, focus on kind of certain conditions that cater to consumers. And one thing that to note generally is that upon meeting with startups, you see a lot of companies kind of diverging from focusing or adopting a consumer-centric way of catering to the consumer and what they want, and kind of being distracted in ameliorating the hardware or software. So that's one thing, kind of like one word of advice for entrepreneurs.
So probably I spent the least amount of time on digital health of the group, but my observation is, I have the privilege to be 30 years in this industry, so I can compare industry one with the other. So what I can see in 2016, there is a lot of quantity of companies. Now, in terms of addressing, major or very well the problem, I don't see many companies that can make a huge impact or turn the industry upside down, and that's what we are looking at. So a lot of very interesting things. I think there is still a few pieces in the ecosystem that are missing. I don't want to be too precise on that because we are looking at some of those pieces. But there will be some technology that will appear within the next couple of years that will basically have a huge impact on the entire ecosystem.
Right. So clearly, it seems like there is a chasm, perhaps even a growing chasm between companies going from a seed stage to a Series A or A to a B. Why do you think that is happening? Do you think that is valuation expectations, ability to meet milestones, just lack of capital? Your thoughts about why you think that the chasm is actually growing? Clearly with the bridges, it may suggest that people need a little more time, but love to get your individual experience.
Yeah. I think what we see on the digital health frontier is in the early stages it's easier to get your first one or two customers. I mean, when you do it as an entrepreneur, it's a big deal. But from an investor side, what we look at is, okay, the first one or two customers, there's an initial hurdle, and once a company achieves it, how does it scale from there? So does it go from 1 or 2 to 4, and even that is okay, and that looks very interesting for us. Then how does that company go from 4 to 8 to 16 and start scaling? And I think that's where the ability of a company to scale in that manner and speaks a lot on the technology that they have, the need that they're solving, and the ability of the team to execute. So in the beginning, it's really hard to say. that's the bet you take on. In digital health, because there's not often a lot of barriers to entry, you're betting on the team to execute. So you're saying, okay, if the team is executing and they seem to be moving, and at an early stage they've got a couple customers and maybe they've got 4, is this the right one to invest in? And further along, as investors are, and we're among them, we're notoriously slow to come to an answer. For us, we try to say no quickly, but even no quickly sometimes takes a while, and a yes takes a lot longer. And because of that, you follow companies' progress. And so when we meet a company in the beginning, they may have 1 or 2, and then if we meet them again a month later or sometimes more, have they progressed? Do they have more people in the pipeline? And so now that speaks as how we look at a company for a potential investment. But then when we start looking at the chasm, as David talked about, is when we invest, do we think that our investment in the next 18 months or so will allow that company to go from wherever they are now to maybe double in terms of customer adoption? Or will there, are we working hard on the product and refining it and making it better so that the user experience is better? And so what ended up before, when a Series A was traditionally looked at as say product development, and a B was initial customer traction and growing that customer base, and a C was for scaling, it's shifted a lot. And so now that's gone downstream, and Series B investors are waiting for these companies to be much farther along, and so we're bridging and we're putting more in. And so for us, some of the strategies that we've done to take that into account is we've gotten careful, we're waiting for companies to be farther along, and we're syndicating earlier. So we're getting more money around the table so that the investors are protected in the beginning. And that has certain good and bad things about it from the entrepreneur's point of view as well, because you're having to hit multiple investors and try to balance the needs of multiple investors. But what often happens is if you get a very interested party that's like, hey, I think this is a deal we're going to do, then kind of wrapping on other investors sometimes can be a little bit easier. But that's the approach. That's what we're seeing, and that's what we're doing. But the chasm, as David mentioned, is real, and it's something significant as we look at investments.
So I'm going to switch the order. So I'm going to have Manu go next, David, so that it's not so predictable.
Oh God, I wish I had more time to prepare. Anyway, given that we're a corporate VC, we're in a way we look for while we invest in early stage startups, we look at kind of de-risked models in a way. So that's why our first 2 investments were a Series B and a Series C. Now, when it comes to seed and Series A, when I look at them, I become more pickier. I adopt a more pickier lens, and in a way, there are so many of them that one shouldn't fall into like the FOMO trap where you have the fear of missing out. So we're more likely to say no quicker to kind of early stage investments and kind of put the excuse that we need to see more traction. So that's one, and I feel like the chasm is growing, or it's becoming bigger because generally investors are having high expectations, and they keep comparing and contrasting all of these startups, and within each field you find so many substitutes and so many competitors that at the end of the day it's kind of it's hard to choose, but at the end of the day there are so many choices there as an investor.
So to come back to this chasm question, I think that there are 3 categories of companies. The first one, they've been funded and they did not reach basically a milestone, and this is very difficult, and it has been in the past, etc. Then there's second category, which is companies that are somewhat in between, and I think these are suffering the most because they have not yet proven, and they need to go back to venture capital, and they have not yet reached an inflection point. And then there is the third category, and these are the one where we are interested, is a company basically who have reached an inflection point, and where basically we are looking to bring the capital for the company to go all the way. That means it's very important in digital health to make sure that the company has enough money because there is a perception in the industry and you don't want other competitors to fund those companies. So we are looking at companies who are overly funded and where the syndicate together can really take the company all the way.
I think most of it has been said, but maybe going back to one thing that we discussed earlier, David, is also it's difficult to fail early in this particular field. Whereas, and when I said it's a true hybrid field, I think that it's probably underestimated how much of a hybrid field it is. So you have maybe tech players who are not entirely aware of, let's say, some regulatory aspects of this particular field that you run into. Then you have some of the more traditional pharma players who are not necessarily aware of the upticks in valuations that are attributed to these particular investments. So you get guys who are maybe at some point out of their depth on a technical level, and some guys are out of their depth on a valuation level. So that is one of the observations, at least in Europe in particular, that we see why this particular divide is happening. But then again, I mean, it's also not that bad. There is a chasm, but it's not that necessarily that bad because there's also the ability to separate between those companies who maybe don't have the ability to bring it further and those who do. So there's a consolidation at an earlier stage.
So that's a follow-up question. So following on this whole idea of difficult in failing early, you know, as investors, do you value the abilities of company to pivot, which is in technology, you know, you've seen many examples of when companies have pivoted and become very successful. Yet it could also be a trap in which that there's additional funding or bridging to a certain point. So how valuable is that ability to detect when to actually pull the plug?
Yeah, sure. I think that there's no single answer for that. I mean, it depends on a case-by-case basis, right? It's very important. It's an interplay between the company and the board, to be very honest with you, and the ability of investors to also adapt their vision and basically see what needs to be done to create value in the end and ultimately impact patients. So yeah, I'm sorry, I don't have a single answer for that.
Well, for us, we invest in late stage, so we typically won't invest in, you know, a pivot, but we will invest on next product or an acquisition or combining. I'm a strong believer in more and more private-to-private mergers and where you can consolidate in an industry, and I think we will see more and more of that happening.
I think the way I look at it is a lot of our companies pivot. They pivot all the time, and it's not easy. So there's a few questions you have to ask. So on one hand, you still have to ask, is the fundamental thesis still correct? So are you still solving a problem that is a must-have and that's a solution that people will adopt? Now, the pivot may be for any number of reasons. It could be that you picked the wrong customer base. Instead of a physician, you know, buyer, maybe you know, physicians don't have money typically, you go towards hospitals. And so was it a business model pivot, or was it a pivot on the product, or was it a pivot on another piece of the company? So understanding why they did it in the first place is key. The second then, the third piece then is, do we think that there's going to be success there, and can the team execute on that? So it still gets down to some key components, but we're okay with pivots. We just want to understand a few of those the reasons as to why a pivot's necessary.
So if we believe in the assumption that money is getting tighter and that, you know, investors are getting more selective about, you know, particular investment ideas, what, from the position of the entrepreneurs and the startup companies, what kind of money should they be looking to get? Is it financial investors? Is it strategic investors? Is it just depends on their business model? Any thoughts? Any literally suggestions? I'm gonna go.
So the kind of investors really depends on the sector. We tend to say if you take some strategic, you better take a couple of strategics rather than just one. And yeah, so
Does that happen? Really? Or if you were once, strategic, would you take money from strategics at the same space or potentially different spaces? I mean, can they coexist?
Well, what you are looking is a market, right? People can help you with the market, and so it could be geographic opening, it could be sector, new sectors, obviously, and in certain cases, people that can acquire the company. But then, it's. I mean, we've seen both single and multiple, but the multiple is easier to play.
Okay.
I mean, given that we're a strategic, usually like our value proposition is basically, we're going to leverage our global presence as a pharma group. We're backed up by a global pharma group whereby we can expedite the growth of the startup, and we can use our in-house teams in order to also help the founders in kind of bringing the idea together. So, I mean, back to your question, David, it really varies on the objective of the startup. At the end of the day, having a strategic on board, I think, obviously I'm biased, is very helpful because they do a lot of the hand-holding, they open up doors, given the resources that they have and the technical expertise.
Yeah. And Edward, do you agree?
I first love to hear Akil's opinion. I've got a very strong opinion on this.
Okay, I'll give you my opinion. So, from an entrepreneur's point of view, if you're getting money and you pound the pavement and it's a corporate entity, I would take the money. I think if you believe it's the right company for you and you're getting an investor at the table and you think you've given a fair shake with a bunch of other venture types, I would take the money. Now, from a venture investor's point of view and a non-corporate, I would say that we like to bring corporate investors in later. And there's a number of reasons. It's typically around if we can, as a company, well, let me back up. Once we invest in a company, we're a partner with the company, and so we're all on the same page. And for us then, we have a very selfish need to get more money in the company, but at the highest valuation. So we're on the entrepreneur side. And typically, corporates will have a lot more money, and the ability for them to go from 5 million into a company to 10 million, if it's a billion-dollar company or a multi-billion, you have that leverage. And typically they're bound by either a corporate or governmental statute on how much equity they can own. So it may be 5% or it may be 20%. So you can play the numbers as to where you can go on amount of money coming in for the equity trade-off. And so as long as you can forestall that into, we like to say Series C and beyond, but it really gets down to the need of the company and the money that's around there. And ideally, and I have to agree with Sven, is that we like to have more strategics in than just one, because one typically means that people assume that there's a predetermined outcome as to where the company's headed. And so in a non-healthcare deal, we had a memory company where we had a couple big tech front entities come into a company. They both came in at the same time, and it was nice because when the company was eventually acquired, both companies were very interested in it and they bid against each other. And so it was a really nice play. And that's ideally what you'd like. Now, the chance of that happening is slim, but you still want to play for those odds.
So for us, we like to go in early, and to be very honest, so it's sort of, I think there's a lot of education to be done in this particular field. So if you look at what corporate venturing has done, we've been around for a fairly long time, and we've learned our lessons that we can't invest with option rights. We cannot invest straight from the balance sheet as a corporate. We're not doing that. We're a separate fund, separate entity. There's Chinese walls. There's no information flow. Yet still in this space, we are seen as Merck, where we are Merck Ventures. And that is a very different thing. And it's a very different thing that we're trying to educate everybody on. So I hope that everybody here, we can educate you guys on that. Because for us, it's not the same thing. So where the money comes from for us, it actually means, in our opinion, the best of both worlds. We don't have a closed-end fund life. We can keep our positions for as long as we want. We can be supportive. We bring more to the company than only money. We bring potential advice. We bring potential interactions with a big pharma player behind us that you can have discussions with. but only on an investee, let's say, initiated basis. We won't do that if there's no need for it. Now, secondly, as an investor, we will always have a fiduciary obligation towards the company, the co-investors. So it is in our interest, as Akil also mentioned, when we invest, to get the highest valuation of the company. And so with that, there is a very weird conflict of interest if you are too close to the mother firm, that if you facilitate in the end an exit with this particular company, you're trying to sell it for the highest price possible, whereas the money comes from the same source. For that exact reason, we separated the two. We are an investment fund with one single LP, because we need to be on the side of the entrepreneur and of the investors that we invest with. Otherwise, we won't ever get a deal anymore. And what is the difference otherwise between business development and corporate venturing? So that is for us the only difference that we see is the source of where the money comes from, and let's say the length of the investment that we can facilitate.
Can I add just one more point? Now, it may not hold in Edward's fund, but I'll tell you the other issue about having corporate funds invest early is if your champion changes, okay, ultimately as a person in a large corporation, that individual may have other opportunities in the future, right? So he may be there or she may be there in 2 years, maybe not. And so when there's a smaller amount of money coming in, say it's 500K or 2 million, when that champion leaves, you really expect someone to pick the ball and be that champion for you. That person may or may not exist. And so when it's a smaller amount of money, it's easier for that corporation to say, okay, maybe it's not aligned with what we want to do in the future. Do we have anyone that can take the ball forward? And so there's a little bit of that potential that could occur in terms of taking corporate money earlier. Now, if it's a $5 million or $10 million check that's going in, someone's going to pay attention and follow that along. I mean, that's the only trade-off I would say.
A quick addition to that. Actually, that's a fair point, and I would urge any entrepreneur, if you are in the position to take money from different sources and do diligence also on your investors, by all means do that, because corporate venturing is an umbrella term that doesn't necessarily describe each and every player in that field. And that is something that we run into all the time, because we like to think that we're much more of a separate player in there than some of the other players perhaps are. And so with that, it is very difficult. If you, for example, have the head of BD being the same guy on the board, then where is your separation of information? How do you know that a transaction price that's being offered is not going to be back-channeled to put in a competing offer? And to what extent is that information that is not that? So we firmly oppose to those practices, but there are indeed still things that are being done on that end.
Yeah, Edward, I believe that's actually a really good point. And ultimately, entrepreneurs and startup companies, you do need to do diligence on where the money is coming from. I mean, I think that's just good practice overall. So, just looking at time, we're gonna ask each of our panelists to give just one quick word of advice for the people out there, anything that that's top of mind, and then we're gonna open it up for questions. We're gonna start with you.
So I would say it's hard to give one, but I'll tell you one that I see that may be more particularly relevant in the healthcare IT side. So when a company comes in and as it's being formed, then they're talking to potential physicians, especially as advisors. It's, companies will come in and give us a slide that'll show a long list of advisors that have maybe some relevance to what they're doing. They certainly will have a lot of names and titles that'll go after them. The key thing I ask is, how did that particular advisor help the company? So maybe it's on product, maybe it's on, some connections for a trial. But, I think the biggest thing that I really ask the entrepreneurs is that particular individual, can they help get a customer for you? Okay. So to me, that speaks a lot, because if there's an advisor that can drive customers and customer adoption and facilitate that means that there's something there, because the physician, the physicians in general, and I as a physician, we'll have limited bandwidth to tie ourselves into companies. So we feel that we have to add something of value. Now, some physicians will just do it to say that maybe they want to be part of a startup in some way. But from an entrepreneur's point of view, what I would do is really push those physicians to say, what can you do for me that I can't get anywhere else? And in that regard, I would really push all of you as entrepreneurs to push these physician advisors to say, okay, if you really believe what we're doing is right, and you believe our product is good enough, can you introduce us to the nursing director at the ER who may be able to champion this, or the chief nursing officer, or the COO or the CFO of the hospital they're in, to get a potential pilot started, but really facilitate that process. I think, to me, at an early stage, the advisors have very clear-cut needs as to what they're doing for a company. So I would really push those advisors, rather than just list them on a slide, see how they can really help your company in terms of getting that early traction.
I mean, very shortly, I would say don't be afraid to ask questions. I mean, there's a lot of investors out there. Don't be afraid as an entrepreneur to also ask questions, where that money comes from, what the goal is with that money, how long that money is still available, etc. We have seen multiple deals die, unfortunately, at a relatively later stage, where some of the investors in there either didn't have the funds to follow through, had unreasonable clauses on some things, and that was all, sort of facilitated by, let's say, the drivers from an LP side. So ask questions and also be critical towards your investors. That is very shortly my thoughts.
My word of advice would be, don't underestimate the power of interpersonal skills. I mean, at the end of the day, having industry knowledge, having the technical expertise and the passion is great, but don't underestimate the chemistry or the likability factor. We've come across a lot of startups whereby the technology was great. They had a good business plan, but I mean, at the end of the day, they weren't people. Because at the end of the day, they weren't people who you would actually marry, right? Like it's a long-term investment, and at the end of the day, if you can't get along with those people, then it's a deal breaker. So that's my word of advice, I guess.
Yeah, I join you, Lana. And I would say my advice would be to make, we make a lot of reference about the entrepreneurs, so do the same about the VCs, and don't hesitate to call or ask to call some of the entrepreneurs, and they will be basically saying, how it is like to be in bed with the firm. And I think this is very important. Not everyone has a good chemistry, so don't try to force something if you don't have the same values and vision. It's go and think beyond money.
Yeah. Great, thank you. Yes, and we're going to open up floor for questions. I hope that the questions you ask is more general. Sometimes we get questions that are very specific to individual companies. Hopefully we'll get more general questions, but please, go ahead.
I wonder if you can talk about what's hot and what's not in terms of specific areas within IT that you're looking at right now?
Okay, so actually I could start. I like data. I like people who actually work with data. So, and that could be played out in a lot of different ways, but I personally believe that if you're doing something interesting with data, then you could actually create a defensible, company. You want to just go down the line, or whoever wants to just step up?
I actually, I like data as well. The other area that we're spending time on is, I think, the broader healthcare IT piece. So how can hospitals as unique customers be for different companies, especially around enterprise plays, around cloud storage, around data server technologies. So it's a little bit different than, or it's a different version of digital health, but healthcare IT at a broader play.
Our key area of focus is essentially around patient-centric care. So how can you deploy something actually to empower the patient to follow its own treatment pathway, and accompany, let's say, a disease-modifying agent with a digital solution that you can have a specifically tailored treatment for you, rather than something, a dose regimen for all.
I mean, for us, I know it's a buzzword that everyone's kind of sick of hearing, but it's big data analytics. So, once we look, even if it's a hardware play, we look for entrepreneurs or startups that are also building the software infrastructure and, kind of data mining, machine learning part of things. Because, the value is in the data, I think, at the end of the day.
So we have one category which is basically a combination of the hardware and the software. So so you can have a multiple competitive advantage. And then there are the pure software play. We are an investor in bioinformatics, genomics, and we believe that that field will have a huge impact on the entire ecosystem.
So I want to take this opportunity to actually thank Edward, just in case he has to leave at any time. So just so you know, he's not in the room now. Okay, another question? No questions, please. Then
I do have a question.
go ahead.
Do any of you across the table syndicate with large family offices for that specific reason? So,
I could start by saying that, so my background is I spent a lot of years in ventures working with firms that had wrote big checks. I realized that in the digital health space, you don't need to write a big check. And that, but if you want to syndicate, it requires that I may have to start working with either family offices or super angels or seed funds that are willing to write a smaller check. So I personally would, down the line.
Yes, we would, and we have done that in the past. I think it's, for us, it depends on I guess the value that that particular family office would add. But there's different ways we can work with family offices. So yeah, we would be open to that.
Yeah, same for us. Just we love to engage in a discussion and see if there's any value add or synergies.
We haven't done this in the past, but we would be open to it as well.
So I have some precise example where we have family offices, but there are people who are coming from the industry and they can really add something. If they cannot add money, then we ask them to invest in our fund.
I'm interested in, as a CEO of a software analytics company, your views on IP and how, it's an interesting space for IP, so I'm just interested in, are you looking for it in the companies or how you're...
Yeah, it's actually the last question I ask because I don't think it should be the first. It's usually I look for people's ability to execute because that's probably what's going to make you successful and not if a particular algorithm that someone could copy very easily.
Yeah, I agree. I think we assume that there's probably very little IP that's possible. I mean, there are certainly instances where there's potential, but it's for us, it's really how quickly the company can scale and become a leader in the space, and whether it's protectable just by branding.
Yeah, same for us. It's fairly relevant in the early stages because we've come to conclude that there's probably hardly any. So.
Likewise.
Well, for us, IP is important because specifically in an area where we combine hardware and software, we are trying to put our flag. And the way that the company is developing IP is also very important. And for instance, we often advise companies not to put an IP that is describing everything, but you bring the beginning, you bring the end, and you leave the piece in the middle unprotected. So you have some protection, but so that's if you look at the bioinformatics and next generation sequencing, one of our company we have some good IP and we could fight from recently a company and successfully.
Great. Well, thank you, everybody. I'd like to personally, thank the panel for making time to do this and sharing your wisdom. It's 10 minutes till. I think some of us will stick around if you want to ask questions. Otherwise, again, thanks for attending this panel.